You know that feeling when you are standing at the gas pump, watching the numbers scroll up faster than you can blink, and for a split second, you feel a little dizzy? Or maybe you are at the grocery store, and you just put back the avocados because, honestly, who can afford $3 for a piece of fruit that is going to rot in 3 days? It is this quiet, nagging stress. It is not panic, not yet. It is just this hum in the back of your mind. You work hard, you put the money away, you try to do the right thing, but somehow, the money feels like it is evaporating. You look at your savings account. You see the number. It looks safe on the screen. But then you look at the price of eggs, or the interest rates on your credit card, or the news talking about bank failures, and you wonder. You wonder, is this actually safe? Because if the last few years have taught us anything, it is that the rules of the game can change overnight. And I think there is a specific kind of anxiety that comes with holding cash right now. It feels like you are trying to hold water in your hands. You want to keep it liquid, you want to keep it safe, but the world feels like it is heating up and evaporating your purchasing power. You hear the experts talking about diversification and bonds and the stock market, and honestly, your eyes just glaze over. You just want to know, if things go wrong, where do I put the cash so it is still there when I need it? My name is Jack, and I spend way too much time thinking about money, financial history, and why some people seem to sleep soundly at night no matter what the market is doing, while the rest of us are up at 2 a.m. refreshing our banking apps and wondering if the FDIC limits actually apply to our specific complicated lives. It is funny, because I was not always this way. I used to think finance was just math. Just numbers on a spreadsheet. If you earn more than you spend, you win. But the more I dug into it, the more I realized it is not math. It is psychology. It is history. It is this weird, invisible game of chess being played above our heads, and most of us do not even realize we are the pawns. And when I started looking into what happens during banking crises, real banking crises, not just the little dips, I found something that blew my mind. It is a strategy that dates back to 1945. It is something that was whispered about in the aftermath of the war, when the world was trying to figure out how to rebuild, and how to store value when governments were printing money like it was going out of style. It is not crypto. It is not gold bars buried in the backyard, although honestly, that is not the worst idea. It is something much simpler, much more elegant, and frankly, it is something that nobody talks about because it does not make Wall Street any fees. It does not make the banks any money. So they ignore it. But by the end of this video, you are going to look at your wallet differently. You are going to look at that stack of emergency cash you might have stashed in a safe or that savings account, and you are going to realize you have been playing the game with one hand tied behind your back. We are going to talk about how to turn your cash from a melting ice cube into a fortress. Not by gambling, but by thinking. So grab a coffee, get comfortable, and let us rewind the clock to 1945. So let us get into it. The year is 1945. The war is just ending. Europe is in shambles. The financial systems are they are a mess. Currencies are failing. People are carrying wheelbarrows of cash just to buy bread, or they are terrified that the new government is going to declare their old money invalid. In that chaos, there was a realization. People realized that if you left your money in the bank, you were at the mercy of the bank's solvency. But if you took it out, you were at the mercy of inflation. You see, this is the trap we are still in today. It feels like binary choice, right? You leave the money in the bank, and you risk a failure or a bail-in where they take your money to save themselves. You take the money out as physical cash, paper bills, and you are safe from the bank failing, but you are toast if inflation spikes because that paper is just, it is paper. It is a promise, and promises can be broken. But in 45, people got creative. And I am not just talking about rich people in suits. I am talking about regular folks who had watched their life savings vanish twice in 20 years. They developed what I call the 3-layer pouch strategy. And I know 3-layer pouch sounds like some weird late-night infomercial product, but bear with me. It is a mental model, but it translates to where you physically and financially put your money. The first layer is what everyone thinks of, but they get wrong. This is your now money. This is the cash you need to buy groceries next week, pay the electric bill, keep the lights on. Most people, when they think about a banking failure, they run to the ATM. They take out $1,000, maybe two, and they stuff it in an envelope in a dresser drawer. And look, that is better than nothing. But it is not strategic. Because here is the thing nobody tells you. In a real crisis, cash is king for about 48 hours. That is it. Think about it. If the banks shut down, or the digital payments go down because of a cyber attack or a system failure, you have got maybe 2 days before people start realizing that the paper money in their hand might not be worth what they thought it was yesterday, or before stores stop accepting large bills because they cannot make change. Panic sets in fast. So, the 1945 strategy for this first layer is not just have cash. It is about denomination. You do not want a stack of $100 bills. You know how hard it is to break 100 at a 7-Eleven when things are normal? Imagine trying to do that when the clerk is stressed and the register is locked down because the card machines are down. You need small bills. 20s, 10s, 5s. Lots of ones. I remember reading a diary from a housewife in London during the late 40s, and she was talking about how having a stack of pound notes was useless, but having a bag of shillings and pennies meant she could always buy milk. It is about friction. In a crisis, friction gets you hurt. You want to be the person who can walk into a store, hand over exact change for a loaf of bread, and walk out while everyone else is arguing about the credit card machine or trying to get the cashier to break a 50. So, actionable step number 1. Go to the bank. Withdraw your now money, maybe 1 or 2 months of expenses, and break it down. Go to the teller, ask for 20s, 10s, and rolls of quarters. It feels silly. I did it last week, and the teller looked at me like I was about to go rob a lemonade stand. But I smiled and said, just like to be prepared. You do not have to explain yourself. Just do it. Keep it in a fireproof bag, but keep it accessible. Not buried in the backyard, but not in the cookie jar where. Layer 2 is your bridge money. This is the money that you need to survive for 3 to 6 months if the system does not just glitch, but actually breaks. This is where the strategy gets interesting because it addresses the inflation problem. See, if you keep 6 months of expenses in paper cash under your mattress, you are making a bet. You are betting that the value of that cash will not drop significantly over the time you are holding it. And historically, that is a bad bet. Governments love inflation. It is the invisible tax. It is how they pay off debts without raising taxes. If you are sitting on a pile of paper dollars for 5 years and inflation is at 5%, well, you do not need me to do the math. You are losing buying power every single day. So, what did they do in 1945? They did not just hold paper. They held obligations. They held things that were essentially cash, but had a tether to the real world. Here is the secret nobody talks about. Tier 1 commercial paper and short-term municipal bonds held in physical form. Whoa, okay, I know that sounds incredibly boring. Like, put me to sleep boring. But stick with me. This is the gold nugget. Back in the day, you did not just have a savings account. You had a savings bond book. You had physical certificates. And here is why this matters. In a banking failure, the stock market usually crashes and the bond market gets weird. But short-term debt, specifically debt that is backed by essential services like water, power, or rail, tends to hold its value. Why? Because if the lights go out, nobody cares about the government, they care about the power company. Now, I am not saying you should go out and buy complicated corporate bonds. That is risky. But the 1945 mindset was about looking for utility. Today, we can apply this by looking at what I call synthetic Tier 1 assets. Now, this is where we have to be careful. You cannot just buy ETFs because those are digital. If the broker fails, you have a claim, but you do not have the asset. The strategy here is to split your bridge money. Half in physical cash, small bills, remember, and half in something that tracks real value but is not the stock market. And honestly, for most people, the closest thing we have to that 1945 stability today is gold and silver eagles, but not in the way you think. Everyone talks about gold like it is a magical hedge. And it is sort of. But if you buy gold coins, you pay a premium. You pay 5%, 8%, sometimes 10% over the spot price. That kills your returns. The 1945 strategy was not about buying the shiniest gold coin. It was about buying gold at par or as close to it as possible. This is why I love older, circulated pre-1933 gold coins, or junk silver. I know junk sounds bad, but junk silver is just old US dimes, quarters, and halves that were made of 90% silver before 1965. They are not collector's items. They are essentially round, silver bars stamped by the US Mint. Here is why this fits the 1945 strategy. In a total meltdown, if you need to buy a tank of gas or a bag of rice, are you going to hand over a 1-ounce gold eagle worth $2,000 and ask for change? No, that is dangerous. You are advertising yourself as a target. But if you have a roll of silver dimes, you can trade a few dimes. It is fungible. It is recognized. It has a floor value based on the metal, but it is small enough to be useful. I was at a coin shop once, little hole-in-the-wall place, smelled like old paper and dust, and the owner told me about his dad in the 70s. During the stagflation crisis, his dad used silver dimes to pay for minor repairs on the car because the mechanic trusted the silver more than the dollar bills. That story stuck with me. That is the bridge money. It bridges the gap between paper money is failing and the new economy has not formed yet. So, for your second layer, look at silver. It is cheap right now relative to gold. It is accessible. It is real. Keep it in the same safe as your cash, but separate. It is your inflation hedge that you can actually spend. This brings us to the third layer, the top of the pyramid. And this is the one that makes people uncomfortable. It made people uncomfortable in 1945, too. Layer 3 is your reset money. If the banks fail and the dollar crashes, and we have a true reset of the financial system, your cash is toilet paper. Your silver is great for bartering, but you cannot retire on it. What do you have left? In 1945, smart people did not just hold cash. They held production. They held the means to create value. Farmers held seeds. Machinists held tools. Craftspeople held raw materials. Okay, so you are probably not going to go out and buy a wheat farm today. Unless you are, in which case, cool, can I visit? But for the rest of us, we need a modern equivalent of holding production. The modern version of this is skill liquidity and essential hard assets. Let me explain. Money is just a storage of potential energy. It is stored work. If the money fails, that stored energy vanishes. So, you need to store that energy in a form that cannot be inflated away. That means skills and tools. Think about it this way. If the grid goes down or the economy freezes for 6 months, who is the most valuable person in the neighborhood? The guy with a stack of cash? No, because nobody can give him anything for it. The most valuable person is the one who knows how to purify water, fix a generator, grow food, or repair a roof. The 1945 strategy for Layer 3 was investing in yourself. Learning a trade that does not rely on the digital world. It sounds so cliché, right? Invest in yourself. But we usually think that means taking a coding class or getting an MBA. In the context of a banking failure, it means getting dirty. It means buying a good set of tools. It means learning basic carpentry or first aid or gardening. I have a friend, honestly, he is a bit of a doomsday prepper, but in a fun way. A few years ago, he stopped buying stocks. Instead, he spent that money building a greenhouse and buying a really high-end water filtration system. I used to laugh at him. I would say, dude, just buy index funds. But last winter, when the pipes burst in his neighborhood and half the street was without water for 3 days, guess whose house everyone went to? He did not charge them, but he established himself as a pillar of the community. That is value that cannot be seized by a bank. And you can do this on a smaller scale. Maybe you do not build a greenhouse, but maybe you buy a spare propane heater. Maybe you stockpile the medications your family needs. Maybe you buy a quality sewing machine and learn how to fix clothes. In a depression, people do not buy new clothes. They fix the old ones.